Every trader dreams of consistent profits, yet most fail not because they lack a good strategy, but because they fail to master their mind. In Forex, charts, indicators, and strategies are important, but your psychology decides whether you win or lose. Today, let's talk about the psychology of winning trades and how you can train your mind to think like a profitable trader. Patience over impulses. In Forex trading, one of the greatest battles you will ever face is not with the charts, not with the brokers, not even with the unpredictable spikes of the market. It's with yourself. Specifically, with your ability to be patient. Patience is what separates those who survive in this game from those who burn out too soon. The truth is, impulsive decisions have destroyed more trading accounts than bad strategies ever could. Think about it. You've been watching a currency pair move sideways for hours, maybe even days. You're tired of waiting, your finger is hovering over the buy or sell button, and you convince yourself, maybe I should just take this trade. The market will probably go my way. That little moment of impatience, of trading because you want action rather than because the setup is right, is where many traders seal their losses. The Forex market doesn't care about your schedule. It doesn't move because you are bored, or because you need to make money today, or because you think it owes you after a losing streak. The market moves on its own terms, and the trader who wins consistently is the one who understands this truth deeply. The impatient trader forces trades. The patient trader waits for opportunities. And when those opportunities come, the difference is clear. The patient trader takes high probability trades, while the impulsive one gets caught in noise. Now, let's break it down. Patience shows itself in three critical ways: waiting for entry, waiting for confirmation, and waiting for profits to unfold. Waiting for entry. Not every candlestick pattern is a signal. Not every bounce off support is a guaranteed reversal. The impatient trader sees half a signal and jumps in, while the patient trader waits for the full picture. Maybe that means waiting for a retest, waiting for volume to confirm, or waiting for alignment across multiple time frames. This kind of patience keeps you out of low-quality setups that drain your account little by little. Waiting for confirmation. Think about fake breakouts. How many traders lose money because they see a breakout and instantly jump in, only to watch price snap back and take their stop loss? Patience means you wait for confirmation. You let the market prove itself before you commit. This one habit alone can turn a losing strategy into a profitable one. Waiting for profits. Perhaps the hardest form of patience is after you're already in a winning trade. Most traders can't stand seeing small profits on the screen. They close early, out of fear of losing what they've gained, and then watch as the market moves exactly as they predicted. Without them, patience is the ability to let your winners run, to trust your plan, and to resist the urge to grab a few dollars now instead of a bigger profit later. But here's the paradox: patience isn't passive. It's not about sitting around doing nothing. Patience in trading is an active discipline. While you wait, you're observing, analyzing, reviewing your plan, and preparing mentally. You're building the strength to strike at the right time, not every time. Remember this: successful trading is not about how many trades you take, but about the quality of trades you take. A single well-executed trade can sometimes make more than 10 random ones. The impatient trader chases trades. The patient trader lets the trades come to them. So if you want to step into the mindset of a winning trader, you must train yourself to master patience. When you feel that urge to jump in too early, take a breath. Remind yourself no trade is better than a bad trade. The opportunity you miss today is nothing compared to the account you save tomorrow. Patience is your shield against losses and your ticket to consistent profits. Without it, even the best strategy will fail. With it, even a simple approach can bring long-term success. 2. Detach from money. Focus on process. One of the most damaging mindsets in Forex is obsession with money. Most beginners open their trading platform, stare at their account balance, and let every tick of profit or loss dictate their emotions. But here's the truth: the more attached you are to the money, the less likely you are to keep it. Why? Because focusing on money triggers emotions. Fear when it goes down, greed when it goes up. And emotions are the enemy of discipline. Winning traders understand that money is not the goal in the moment. The goal is executing the process. If you master the process, money will follow. Think of it like this. A doctor doesn't operate while staring at the paycheck. He focuses on the steps, the procedure, the discipline of his craft. The paycheck is the natural result. Similarly, your trading plan, your risk rules, entry rules, exit strategy is your procedure. When you stick to it, the profits will take care of themselves. Let's imagine two traders. Trader A is money-focused. He enters a trade, sees 10 profit, and panics. I better close before it disappears. He sells early, then watches as the market runs another 50 pips without him. Trader B, however, focuses on process. He follows his system: risk 1%, reward 3%. He lets the trade play out. Even if some lose, his winners cover the losses and more. Over time, Trader B grows consistently while Trader A stays stuck. The winning psychology is not about, I need to make 500 today. It's about, did I follow my system? Did I trade with discipline? When you stop chasing money and start chasing perfect execution, everything changes. Ironically, the less you care about money on each trade, the more money you will make long-term. 3. Risk management is mental strength. Every trader says they know risk management, but very few actually practice it. Why? Because controlling risk is not about numbers, it's about psychology. It's about resisting the temptation of, just this one time, or, I'm sure this trade will win, so I'll risk more. But here's the hard truth: no matter how good you are, the market can and will humble you. The one thing you control is how much you risk. That's why true winning traders treat risk like oxygen. Without it, you don't survive. Risk management is not just a strategy, it's mental strength. It's saying, even if this trade loses, I will live to trade another day. That mindset takes away fear, because you know no single trade can destroy you. Let's say your account is 1,000. If you risk 1% per trade, that's 10. Even after 10 straight losses, you're still alive. You can learn, adjust, and recover. But if you risk 20% because you feel, this setup is perfect, one bad move wipes you out. Winners see risk as protection, not limitation. It's like wearing a seatbelt. It doesn't stop you from driving, it keeps you alive when the unexpected happens. And in Forex, the unexpected always happens. The psychology here is simple: accept small losses as part of the game. Never risk so much that losing keeps you awake at night. Sleep well, trade well. 4. Control your emotions. Control your trades. The Forex market is designed to trigger your emotions. Green candles make you greedy, red candles make you fearful. News spikes make your heart race. But here's the truth: markets don't beat traders. Traders beat themselves through poor emotional control. Emotional traders do 3 things: they chase after missing a move, they revenge trade after a loss, and they panic sell too soon. All 3 destroy accounts. The psychology of winning trades requires emotional neutrality. You must approach every trade with the same calmness, whether it's a win or a loss. That doesn't mean you don't feel emotions. It means you don't let them control your decisions. How do you develop this control? By preparation. You know your entry, your stop loss, and your take profit before you even click buy. Once the trade is placed, you let it play out. No changing stops, no moving targets out of fear. Think of a professional poker player. He doesn't slam the table after a bad hand. He stays calm, plays the odds, and waits for his moment. Trading is the same. When you're emotional, you're predictable, and the market will take advantage of you. Winning traders control their emotions by trusting their system. They understand losses are part of the business. They don't see a losing trade as failure, but as data. This shift in mindset keeps them calm, sharp, and ready for the next opportunity. 5. Consistency builds confidence. Here's the paradox of trading: most people want quick success, but real confidence only comes from consistency over time. One big win doesn't make you a winner, just as one bad loss doesn't make you a failure. What defines you is your ability to repeat discipline day after day. Consistency is showing up to the charts with the same plan, the same risk rules, the same patience, over and over again. It's not glamorous, but it's powerful. Because every time you follow your plan, you build self-trust. And self-trust is the foundation of confidence. Think of athletes. They don't just perform on game day. They train daily, repeat drills, and refine habits. That's how they step into competition with confidence. In trading, your drills are journaling trades, reviewing setups, sticking to your risk plan. Confidence isn't pretending you'll never lose. Confidence is knowing that even if you lose today, your system will bring you back tomorrow. Consistency is what makes that belief unshakable. Winning traders don't measure themselves by one trade, one day, or even 1 week. They measure by months, by years. That long-term consistency gives them the courage to sit through drawdowns and the strength to ride trends without fear. So, if you want to build confidence, stop searching for the perfect strategy. Start practicing consistency. Your confidence will grow not from wins, but from discipline. 6. Think like a business, not a gambler. Too many traders treat Forex like a casino. They deposit money, gamble on random setups, and hope to double their account. That mindset guarantees failure. Why? Because gambling relies on luck, while business relies on structure, planning, and discipline. If you want to win in Forex, you must think like a business owner. Every trade is a business decision. Every risk is an investment. Every loss is a cost of doing business. Gamblers see losses as disasters. Businessmen see them as expenses. What does this mean in practice? It means you set goals, track performance, and reinvest profits. You keep records. You evaluate what works and what doesn't. You don't gamble your entire account on one trade. Just as a business doesn't risk its entire budget on one project. Thinking like a business also means patience with growth. No serious company expects to go from zero to millions overnight. They build slowly, reinvesting along the way. The same applies to trading. If you can grow 5% a month consistently, you will be far ahead of gamblers who blow accounts chasing 100% in a week. The psychology shift here is powerful. The moment you stop seeing Forex as fast money and start seeing it as a business, your decisions change. You take fewer, better trades. You respect risk. You plan for the future. And just like a business, your account grows steadily, not explosively. The psychology of winning trades is not about predicting the market perfectly. It's about mastering yourself. Patience, detachment from money, strong risk control, emotional discipline, consistency, and treating trading like a business. These are the pillars of success. Remember, charts don't make you profitable. Your mindset does. The market rewards those who control themselves under pressure. So the next time you trade, ask yourself, am I thinking like a gambler or like a disciplined professional? Because in the end, the difference between winners and losers in Forex is not in the strategy. It's in the psychology.